In this video, I'm going to show you how we were able to buy Alibaba the day before it reported earnings while risking only this much, and how we later on managed that trade for a 70% gain. At around this time last year, Adam Sarhan decided that he wanted to add Alibaba to the model portfolio in the Advanced Stock Report service. This is what Alibaba looked like at the time. It had just come up off of about an 80% run, and it corrected a little over 20%. It broke through the 50-day moving average, found support at this black line over here. That's the 200-day moving average, or well, around the 200-day moving average, kind of dipped below it a little bit. And then it started to rally off of that, and it moved back above the 50-day moving average. In doing all this, right after it started to bottom and it's making this move, it's kind of forming a base, right? And that base looks like a cup with handle, right? So it's consolidating, rounds it out, then it starts to move sideways, forming that little handle, doing it on low volume. That's pretty much what we look for in a cup with handle pattern. There's a whole lot of information on cup with handles. I'll do a video specifically on base patterns later on, but for right now, forming this nice cup with handle. And the thing that we like to look for in any kind of an advanced entry or wherever we're looking to get in is, where can we get in and where does it make sense to logically get out? In this particular pattern that happened to be forming, it made sense to get in right above this little resistance level right here because it was rallying, then started to consolidate sideways, and if it's going to continue that move, it would break right above this point over here, which is where we decided to get in. And to just zoom out a little bit, little spoiler, we got in at the advanced entry point of 97.90, and right before it reports earnings. And this is what it did right after earnings, right? We bought there, and we had our stop loss set down here, so a little bit below where the handle was. It was getting support right around that 10-day exponential moving average, that green line. But we put our stop over here because we like to position size based off of where our entry point is minus where our stop loss is going to be, and then back into the number of shares, so that way we're able to keep our risk constant. We decided to set the stop loss, or the reason why Adam decided to set the stop loss down here versus over here is because we were buying right ahead of earnings, and if we experienced a gap down below our exit, if we position sized over here, we would be hurt significantly more than if we had our stop down here, where it should start to reasonably catch support. Right down here, that's where the 50-day moving average is. There's a little bit of support right there where it was starting to gap up and break back above the 50-day moving average. So logical place for it to start to catch support on a gap down move. It could have went further. It could have went down to the 200-day moving average. But we also need to consider too, well, what's going to make an acceptable reward to risk? Putting our having a position where we would be only risking, say, 9% from our entry to exit, our position size starts to get smaller and smaller. And so it becomes less of an appealing trade. So right there happened to be the sweet spot where we were comfortable with that amount of risk. It was a logical spot for Alibaba to catch support if it did break down, and it was something that allowed us to buy Alibaba right ahead of earnings. Well, we should not. We need to always be careful when we're managing risk, and when earnings is involved, we need to be especially careful. But it doesn't mean that we should not trade around earnings. We just have to know what we're doing. So in this case, we were able to figure out and manage our risk, and we were able to plan for the downside. The upside, we need to manage the upside as well, but the upside takes better care of itself than the downside. So we're always trying to protect our downside. Did that there. Breaks out, starts to run. Once Alibaba starts to make a multiple of our risk, so at about this point over here, when it starts to break out of the what could have been considered a classic pivot, right? If somebody was looking at this as just a cup and didn't look at that as a handle, then typically the high point of a pattern is considered the classic pivot. So by the time price reaches back up there, then we're moving our stop loss to break even on this trade. Now there's a lot of different ways that you can manage a trade. The way that this particular trade is being managed, it's being managed on an intermediate term basis. So the idea is to hold Alibaba for the bulk of the move. And the way that we do that is by keeping our stops relatively loose. Like, we want to bring our stop up to break even as quickly as possible, but we don't want to choke out the trade. Well, we don't want to make sure that we don't want to exit prematurely. And so we raise our stop to break even, and then at that point everything else becomes gravy, and we want to still manage. We don't want to risk too much, so we continuously raise our stops, but we do so at points where support develops. And moving averages, like a longer term moving average, like the 50-day moving average, is in conjunction with the support level. And then we start to look at trend lines, and then our 3-strike rule comes into play, and we'll see all that. So for right now, breaks above this, where the stop is up to break even. So every once in a while during a move, you'll see one of these little dipsy doodle kind of moves, one of these little shakeouts, a flash crash, like one of our members was asking about, and we see something like this day here on May 18th, and intraday that's very scary. And if you're somebody that is a swing trader, you're probably going to end up getting shaken out on a move like that, because it's too much risk, too much intraday risk. And if you're using hard stops, you're probably getting shaken out of a move like that. If your time frame is more intermediate to longer term, then your stop is still going to be down here, and because you're anticipating a move like this. The moves like this happen all the time in stocks, and it's not uncommon. So we need to understand that something like this is going to happen and be prepared for it. And if we don't want to get shaken out, then that means that we have to be comfortable with, at the time, giving up what could have been 12.5%, 13% on our gain. So that's really the main point there. The way to not get shaken out is to be able to accept giving up a portion of your gain. We continue. Alibaba gaps up. It's now getting support along its 21-day exponential moving average, but just because it's getting support at that 21-day exponential moving average doesn't mean that we just keep our stop right at that. Well, we want to make sure that there's multiple reasons why we would exit the stock based on being stopped out of the trade. So Alibaba gaps up on this day. One way to trade gap ups is to buy right after the gap up. So to buy if the stock moves above the day of the gap, and to sell if it moves below the day of the gap. So on a swing trade, somebody could reasonably buy here, end up getting stopped out down here. And if you're also somebody that raises your stop immediately to the low of the gap, then you're also being shaken out on this move. How do you manage the stop? Well, if you are somebody that's trading intermediate term and you're trying to hold for the bulk of the move, you're not raising your stop up immediately. If you bought down here, then the stop loss is below this down here because you want it to still have the 50-day moving average and you still want it to have a significant low. Right, so after Alibaba starts to move higher, breaks above this high, then we're finally able to think about raising our stop up, right? Because at this point over here, Alibaba breaks out, and now we also have this low down here that it established, and we have the 50-day moving average. I have this trend line drawn. This will come into play later on. It's not valid on this yet, but at this point, well, we have two strikes. And when we're in a deep move, that's when we start to look for our three-strike rule. And I'll link the video down in the description, but the three-strike rule is basically where we want to exit on a break of the 50-day moving average, a break of support, and a break of a trend line. So we'll see how that comes into play later on. At this point, we're able to raise our stops up over here to 133. So right at around July, that's where the stop was. And so we're able to still sit through this. You have this little correction over here. So again, it's being comfortable with giving back a percentage of your gains and being able to hold for the bulk of the move and managing the trade from an intermediate term perspective. If you're trying to manage the trade based on the more rules that you come into play, so there's like a lot of sell rules, a lot of sell signals, and if you're trying to do all of them, it leads to a lot of confusion. The thing that's really helped me kind of figure out, okay, what kind of trades do I want to try to hold for a much bigger move like we did with Alibaba versus, more of a swing trade kind of approach, is to have separate accounts where in the swing trading account, it's going to follow these set of rules, these set of signals. In the intermediate term account, it's going to follow these sets of rules and signals. And if I'm only looking at intermediate term trades in the intermediate term account, I'm a lot more comfortable holding something like this than I would be in the shorter term swing trade account. So Alibaba continues to move up. It starts to establish this floor over here. It tests it again, and it continues moving higher, right? So then back in December, right? So back in December, we end up getting shaken out of Alibaba. And it broke the 3-strike rule, right? So we had this upward trend line that it broke, right? So it starts back here, tested it there, breaks it here, right? So broken trend line, broken 50-day moving average. It established support right around here, right? It even undercuts this over here. And, well, we end up exiting on this day, right? Because we're using hard stops. Now, we exit on that day in the model portfolio, and the way that the model portfolio works, it's meant to be very simple that anybody can follow it, and so it's acting as either an all or nothing trade. So it buys the entire position on one day, it sells the entire position on one day. Trades could obviously be managed better than buying all on one day or selling all on one day, particularly for me, selling all on one day. But the purpose of the model portfolio too is to be able to follow trends for as long as you possibly can and to be very easy to manage. So you could have scaled out as you're getting strikes, right? So you could have scaled out. So you got 2 big strikes on that day. You could have sold a portion of it. You could have sold another portion down here, right? So that way you're not losing as much. But the model portfolio sold everything on that day. And of course, that ends up being the low. So what do? We don't just kick Alibaba off the radar and say that that's it. We end up buying right back here, right as it crosses back above the 50-day moving average. And at this point, we are up roughly 14.5% as we await earnings tomorrow. With earnings right around the corner, again, now the question becomes, well, what do we do this time? Well, what you're going to do this time is going to depend on all the things that we were considering earlier. First, what's your time frame? Are you somebody that's looking to trade this as a shorter term swing trade, or are you somebody that's looking to hold this intermediate term or longer term? Short term swing trade depends on where you got in. Did you get in on this breakout right up here? Did you get in down here? What kind of a cushion are you sitting on? If it's me and I'm swing trading this and I got in down here, or if I got in up here, I'm selling at least a portion of this. I love to scale out of positions in my swing trading account. I love to lock in gains along the way, and especially when earnings is right around the corner, I like to limit the amount that I risk. So I'm going to, I really want to try to limit my downside in that swing trading account, primarily because there's a lot of turnover in that account. And so if I get a major hit, so let's say I bought over here and it gaps down to the 50-day moving average, then I'm losing my entire gain and it's now becoming a loss. And so that's something that I need to recoup again. And so I would much rather take the smaller gains in that account and not have to deal with a full loss or more than what could be a full loss. For the intermediate term account, so for the model portfolio, the way that Adam is managing it, he still has the stop loss way down here where it originally was. Now, Adam has 20 years of trading experience, and so that far trumps my own trading experience of roughly about 10 years of solid trading experience where I've been trading seriously, at least managing my own money. And I'm still learning the ropes of trading intermediate term and holding for these bigger moves. And so for me, I'm a lot more comfortable trading short-term swing trading. So this, keeping the stop loss down here is uncomfortable for me, but I am deferring to what Adam's experience is and keeping it down there for this intermediate term account and just following along with the model portfolio. The model portfolio did have and has had outstanding returns. In 2017, it tripled the S&P 500. In 2016, it doubled the S&P 500, and that's when I started taking trade for trade from the model portfolio, and it's worked out pretty well so far. So I'm going to keep on doing that. Again, I'm not exactly comfortable keeping my stop way down there because, it could give back a lot of those gains, but when we look at it as, will we be stopped out down here? Well, in order to be stopped out way down here on an intermediate term basis, you're going through all the shorter term moving averages, true. Then you're going through this potential support level, right? So we know that former resistance should become support, so it should catch support right around here, right around 190. And you have the 21-day exponential moving average right there. Then you have this down here where this was a former resistance level turned into support, tested, bounced off of that, and that's also the 50-day moving average. And then you also have this 100-day moving average too. So many layers of support. Even on a gap down, I doubt that we would end up getting tagged for what would end up being about 20% on a gap down. Alibaba hasn't had that kind of a gap down. Let's just take a quick peek and see what it's done throughout its history. Right, so gap downs. Hasn't really gapped down on earnings at all. Like this drawdown here, right? So just to look at this, the most recent one, most recent drawdown, not gap down, that was 14%, right? And that took about 2 weeks for that to develop. So we're talking about a 20% gap down in a single day. Hasn't happened in Alibaba. I don't think it's happened in Alibaba at all. Well, what's this back here? Way back when it first started trading. Some of my original notes way back there. Let's see. So back here, gap down for about 12%, let's say. So biggest gap down in its history. Oh, let's check out this one over here too, just so that way I am sure of myself, right? So starting from here, gap down about 15%. Yeah, so if it gaps down 20%, that'll be the biggest gap down that it's ever had. And sure, it's possible. Anything is possible in the market, but we're looking at it doing this in what is still a very strong bull market, that is still a market leader, something that's very strong fundamentally and has been outperforming the S&P 500 for a very long time. I think that the stop loss down there has a very slim chance of getting tagged. So that's why Adam has kept it there, and why the model portfolio has been as successful as it has been, and why it's better for somebody like me that is still learning how to trade better on the intermediate term to look at this, follow it, and continue going. So that's it. If you would like to take advantage of the Advanced Stock Report service, see the model portfolio in action, have direct email access to Adam Sarhan for all of your trading questions, have direct access to me for all of your trading related questions, get intra-week updates, and a whole lot more, you can sign up and get 3 months for only $27. Use coupon code 3427 and sign up using the link. I'll link it somewhere here in the video. I'll also link it down in the description, and take advantage of it. It's 3 months for $27. 3427 is the code. Thank you all so much for watching. I truly, truly appreciate it. If you have any questions at all, please leave them in the comment section below and I will personally help you. Also, if you like the video, click that little thumbs up button. That's really going to help us out a lot. And also make sure that you subscribe to the channel so that way you get every single update. Thanks again for watching, and I'll see you again in the next video. Take care and have a great day.